This is a critical update regarding the global financial system. Recent developments suggest that the long-anticipated collapse of the derivatives market is imminent, with the silver futures delivery crisis acting as the primary catalyst. The China Catalyst, a historic directive, has been issued by the Chinese government. Instructions have reportedly been sent to Chinese banks to halt purchases of US Treasuries and to aggressively liquidate existing holdings. This move signals a complete loss of confidence in the US dollar and sovereign debt, marking a definitive shift in the global financial paradigm. The COMEX crisis, March 2026. The epicenter of this collapse is the COMEX silver futures market. The critical window opens in March, with February 27th first notice day serving as the final confirmation. Here is the data. Currently, COMEX registered silver stocks stand at approximately 103 million ounces. Historically, physical delivery requests account for only 1% of contracts. However, for March 2026, delivery demand is projected to hit 25%. There is simply not enough physical metal to meet this demand, making a default inevitable. 3 scenarios for default. Analysts have outlined 3 probability scenarios for the coming months. Controlled transition. Contracts are rolled over or settled privately. Expected silver price, $120 to $150 per ounce. Partial default, a chaotic failure to deliver. Expected silver price, $200 to $250 per ounce. System break, a total collapse of the exchange. Expected silver price, exceeding $300 per ounce. Market anomalies and warning signs. 3 major indicators confirm the severity of the situation. First, silver lease rates have spiked to over 20%, which is 5 times higher than the current US 10-year Treasury yield of 4.2%. This indicates a desperate shortage of physical metal. Second, the US Mint has suspended sales despite high prices, signaling inventory preservation. Third, Google Trends data for the search term bank failure has spiked beyond levels seen during the 2008 Great Financial Crisis and the 2023 banking stress. Conclusion: investors should be prepared for a potential freeze of the futures market, similar to the technical glitches observed in late 2025. When the divergence between the frozen paper price and the real physical price occurs, the gap could be hundreds of dollars. The era of paper derivatives is ending. The timeline is set.